Welcome to Non-Consensus Investing. I'm Ram Ahluwalia, your host and CIO at Lumida Wealth, where we specialize in the craft of alternative investments. At Lumida, we help guide clients through the intricacies of managing wealth so they don't have to shoulder the burden alone. Through this podcast, we draw back the curtain to reveal the strategies employed by the best in the business for their clients so that you too can invest beyond the ordinary. All right, good morning. It is Thursday, 11:30 a.m. I'm joined by my friend Skyler. Skyler, we've had on Lumida Non-Consensus Investing, I want to say about a year ago, one of my earlier guests. Skyler has been in the hedge fund business for quite a while. I met Skyler shortly after the 2008 crisis. I was an investor in his fund where he was trading non-agency residential mortgage-backed securities. Incredibly thoughtful individual. We're going to talk about quite a few topics today. First off, tariffs, but we also talk about the state of the housing market, the mortgage market. Of course, Skyler was a trader, bond trader. So understanding the likelihood of the privatization of Fannie and Freddie and what that might mean for mortgage rates. We'll talk about the health of the economy. Did I miss anything, Skyler?
No.
The CLO equity market.
Yeah, whatever you want. CLOs, bonds, the interest rates, inflation, the curve, you name it. Private credit, we can talk about private
credit as well. Let's see how much ground we can cover in the next hour or so. And as you listen, if you have any questions, just post them here. Look, let's start off with tariffs. The admin rolled out a tariff package that exceeded everyone's kind of worst case set of expectations. Markets gap down, continue to sell off. Where we stand today, and there's a lot of surprise out there. There's some reporting on Twitter that the tariff calculation was based on GPT-4 using it really didn't make any sense.
Yeah.
Help us unpack what we've seen today and kind of your read of the situation.
Yeah, you start off with this calculation first, which I've read numerous reports. It was really just based on trade deficits. And you take Vietnam, for example, which I think was the biggest hit. It was something like 67 or 75% tariff. And it gets me to thinking like, okay, what we're not really taking into account here is that a dollar goes a much longer way in Vietnam than it does in the United States, right? So how on earth are we going to expect Vietnam to buy the same amount of U.S. goods that we buy of Vietnamese goods? Is wacky. And then you start thinking about it doesn't really become real until it becomes real. And I have one of my best friends runs an online goods business. He sells sports equipment online. He's like the third biggest seller in his category in the United States. And obviously everything's imported, right? And you're like, okay, this lacrosse stick, instead of costing $80, or it costs, maybe he sells it for $100, instead of costing $30 or $40 to import, now costs $70 to import. And what do? You can't, first of all, raise prices 50%. Can't do that. You're not gonna sell anything. But you're dead. You're absolutely dead in the water. Your business is done.
That's an American business that's importing from Vietnam. And
exactly.
He's paying the price. He's paying the duties at point of import.
His business, his margins go from probably, and we're not including what he's paying for labor and warehouse and taxes and fixed expenses in the U.S. Where you're like, hey, you're selling this for $100, you're buying it for $30 or $40. You still have, even if it costs you $70, you're still making $30. You go from maybe making a 15% margin to making a negative 15% margin.
Because you have the fixed costs.
Yeah, now the business is, all right, I'm done. Okay. So the administration solution is you've had 60 days to find a U.S. manufacturer of the same thing. And if you bought it from a U.S., and like, good luck. You have these supply chains that take 18 to 24 months to set up. Even if you're Apple, bare minimum, it's going to take you 9 months to set up that supply chain.
Years.
And so this business that maybe makes $100,000 to $200,000 a year in net income, they're done. And they're not alone. I think they're forcing the market's hand Like they said, they think that the administration thinks they have a 6 to 12-month runway to break stuff before it's on them.
before the midterm.
And yeah, exactly. Before they start getting blamed. Okay. So they think they have 6 to 12 months to break things. Then they have the subsequent 12 to 18 months to repair things, to make America great again, which, if everything works out, great. But we're already seeing it in these midterm elections that we had, or these special elections that we had 2 days ago, where must spend $21 million for a Supreme Court race in Wisconsin and lost by 10 points. The two Florida races that Trump won by 25 points, he only won by 15 points. Florida, heavy Republican districts starting already to say, hey, no, this isn't what we want. So I'm all for fair trade. But okay, if Canada's has a 30% tariff on milk, we should have a 30% tariff on their milk, or an equivocal tariff on something else. But if you're just like pinpointing it based on trade deficits, and you're saying, I'm trying to cure this trade deficit, you're going about it the wrong way, especially when you think about purchasing power parity. When you think about Vietnam, the standard of living in Vietnam is much lower than it is here. They can't spend what we spend on Vietnamese goods. It's very simple.
And they have a diet of noodles, not generally beef.
Yeah.
There's so many ironies here and so many just inconsistencies. So if you complied with the tariffs and you moved your production from China to Vietnam, like a good American,
Yep.
you're paying more in duties. And you got the least tariffs on Mozambique and the Congo because we don't trade with them by
Yes.
virtue of this formula. So I'll walk you through a few quick headlines here just to orient the audience. So JP Morgan came out and said that they expect inflation can go up 1.5 points this year. New tariffs would raise $400 billion in revenue. Those are really sales taxes on American business, of course. That'd be 1.3% of GDP, making it the, quote, largest tax increase since 1968.
Wow.
The hit to real incomes and spending could bring the economy to the edge of recession, even before factoring retaliation or weaker exports and investments. This is JP Morgan, by the way. This is not a sensational Twitter account. I'll keep going. Geiger, this guy's fairly conservative MAGA guy, by the way. Geiger, right? To your point on people that are saying, gee, what happened? I voted for X, I got Y. He said, quote, no other than, parenthetical, fairly stupid partisans on the left thinks Trump is truly going to implement 20% tariffs on everything across the board. And he's saying, well, Trump 2.0 is very different. Here's Ed Yardeni. I'm a big fan of Ed Yardeni. And he also was one of the biggest bulls on Wall Street, the highest S&P forecasts, and tilts conservative as well. So he said, we've recently warned that Trump's reign of tariffs is very likely to boost inflation over the rest of the year, depressing overall consumer sentiment, real wages, and consumer spending. Rising goods prices could boost PCED inflation rate from 2 to 3. And we know we just had a hot print that came out recently, another hot print in January, meaning exceeded expectations in the wrong way, to 3 to 4% over the rest of the year. If the result is a consumer-led slowdown after a short auto buying binge, the Fed won't be able to help by easing monetary policy if inflation remains well above the 2% target. The result could be 6 to 12 months of stagflation. The economy won't get a boost this summer from fiscal policy if Republicans manage only to extend the 2017 tax cuts already in place. The result will be a tax increase, which could cause a recession. So this is Eddie Yardeni, who's got the Roaring 20s thesis, now using the recession word. Besant was interviewed. Go ahead, yeah.
What were they hoping for? They were hoping for no change, and they were hoping to let's just be very generous. They were hoping to raise $1 trillion in revenue. Okay. In 24 hours, the stock market has lost $2 trillion. Why didn't, so the US stock market cap was recently at roughly $65 trillion. Okay. Today it's at peaked at 65. Today it's at 58. That was as of last night. Overnight, the stock market's lost $2 trillion. So we've lost almost $10 trillion in stock market value in a matter of a few months. Wouldn't this have been more easily accomplished by, let's say, just saying, hey, we're going to tax the stock market 2%,
You could have
right?
done an AOC style wealth tax
Exactly.
or a Bernie
And
Sanders.
just raised all the money you
Right.
needed to
Not
raise.
that I don't support a wealth tax, just to be clear. I don't
Neither do I.
but
But
it
the
would
whole
have been more efficient.
there's this debt clock. There's this, hey, we have the current national debt 34 trillion. We're spending $1 trillion in interest a year. My point is, and you have $160 trillion in net wealth in the United States. You could do a 20% tax and completely wipe out all debt and
Right.
still leave the United States with $130 trillion in net wealth, $130 trillion in assets with zero debt.
That's going to impact pensions, firemen, police workers, state
So
teachers, union.
exactly. So not only are you destroying the wealth effect and keeping consumers and corporations at home and not spending, and look at most economic indicators. It's all consumption based. The United States is a consumption based economy. So all of that's how nobody's spending anymore. And they just lost $10 trillion in the stock market's been lobbed off in the last 6 weeks. And then to boot, for the things they do need to spend money on, eggs and meat and gas and everything, you're talking about inflation and inflation expectations, right? So inflation's only going to, it's a very regressive tax that's hitting Main Street, and you're hitting stocks and residential real estate at the same time. So what good is coming out of it? Maybe you raise 250, $500 billion in revenue, but they're talking about putting they're talking about cutting taxes to the equivalent of $500 billion per year. Okay, you're paying for 1 year's of tax cuts.
You're talking
But if
about
people aren't spending, and if people are afraid to spend, and especially corporations looking at research and development and stuff and building plants, if they aren't spending that, well, they're just going to pocket those gains.
and small businesses are going to get hurt. And to your
Yeah.
point, your anecdote about the entrepreneur who's importing hockey sticks from Vietnam,
Yeah.
they're going to have to shut down. And you tell that story times.
So unemployment's going to go up, right?
Unemployment goes up and the tax revenue drops.
Yeah.
That individual is paying taxes.
Right.
Now that business is unprofitable. And now those laid off workers will get unemployment benefits. So spend on that will increase.
Yeah.
And the turnover in the labor market is lower than it has been in a long time. So it's not easy for the labor market to absorb workers.
Yep.
Yeah, I'm not sure what they're accomplishing. The 10-year, arguably you could say you talked the 10-year down.
You did.
But the 10-year, yeah, it has. It's still not as low as it was in September when it was 3.6%, where you also had a growth scare, not as severe as the current growth scare, but the 10 years is not responding enough. So you're not even getting a benefit on the ability
Diminishing returns.
That's correct.
Yeah.
It's in the interest of the U.S. government to just issue more T-bills again.
Yeah.
It's
Well,
a lower
it's announced.
10-year.
So there was a surprise announcement today. They're selling another, out of the blue, hey, we're selling another $50 billion next week.
Of T-bills?
T-bills, yeah.
What's the
They
point?
opened up one of their most recent issuances. Everything else is the same, but we need to raise more debt.
So you don't get the win on the 10-year. The other big question here has been, we've been seeing a lot of soft data, meaning on surveys, Michigan Consumer Sentiment Survey, CEO confidence, small business survey. By the way, a lot of these were up and to the right, all-time highs, except for the Michigan Consumer Sentiment. Then it depended on your kind of party affiliation, who you voted for. CEO confidence tanked, small business confidence, and now sentiment doesn't matter who you voted for, that tanked also. So now we're starting to see translation into hard data. So Challenger publishes an announced layoffs statistic every month. It came out 1 or 2 days ago, and it's up 200% year over year. Now people are going to say, well, federal workers. No, 60% of that is private workers. And we saw this morning a weak.
That was today. The prior was 100%, and today's actual was 200%.
So look, that's a leading indicator of a non-farm payrolls report.
Yep.
That's going to come out next month and the month after. We also had a weak ISM services.
Yeah.
And as there's a services economy, and people aren't going out to restaurants as much anymore. We see that in the transcripts. We saw international travel pull back. Delta had
travel's way down. Yeah.
Correct.
Tickets purchased.
That's right.
I flew off Dallas to New York last week. The flight was only half full to LaGuardia on Delta.
Wow.
And I was like, I haven't seen this since COVID, where half the flight's just empty.
People are still flying to Puerto Rico, as far as I can tell, but that's the next strata of the. But yeah, business travel. Like, travel is a luxury for a lot of people, and that's pointing back to. So we are starting to see this impact hard data, which is something that we've been looking out for.
Yeah.
So yeah, tariffs. How do you see this unfolding? Right, you've got tariffs across the board. Mexico has 0 tariffs in the United States, by the way.
Yeah.
I think they can do better, and their stock market's up 5% today. I think they'll.
Wow.
I think Trump needs a strong Mexico, so it's no surprise there. But how do you see this unfolding over the next few months and a year?
So you've had the dollar's down a couple points today. You have a weaker dollar. I think the market is just in complete shock. And you look at higher beta names that are down 10% today.
Lululemon down 12%. Nike.
Yeah, Restoration Hardware down 40.
Wow.
Wayfair, huge importer of hard goods, furniture, down 26%. Shopify down 17% today.
Wow. Growth stocks are going to take it on the chin.
Yeah. Plaid just raised money at half their 2021 valuation. They just raised money at $6 billion versus $12 billion in 2021. So I'm a long-term guy. I think long-term we're going to be fine. I think what Besant said a week or two ago was right, in that the economy has been driven by very cheap money, especially since COVID, very low interest rates plus tons of stimmies. And so, let's break some things. Let's have a pullback. Look at housing, for example. The housing charts, we're at 20% above where we're supposed to be in terms of trends. Great. All right. If housing's flat for the next 4 to 5 years, great. We're back on trend. Can some areas in housing,
median house prices?
Yeah. Okay. Are we seeing a pullback in the Sun Belt? Yep. Prices are going to drop 20%. Northeast, Midwest, prices are going to stay the same because there's just a lot more demand than there is supply. So the market and the U.S. economy needed some austerity, but to do that in conjunction with basically irritating the entire world is it's not the way I would go about it.
The approach is the wrong approach. It's the wrong approach. International
Yeah.
stocks are trouncing U.S. markets now.
Right.
The lower value of the dollar makes cost of living higher. Canadian lumber is 30% of the lumber used in building a house. You got tariffs on that too. That's going to increase the cost of a house also.
It's just a bad approach. I think people, corporation CEOs, all those surveys will turn into higher unemployment and higher inflation and slower growth, i.e. inflation. And it's in the cards. The most recent Atlanta GDP, I think it got revised down to negative 3.4 from negative 2.7 for first quarter here. So it's already in the cards that we're seeing a slowdown. We're going to see an earnings decline, a major earnings decline from the 2 years. We had 2-year gangbuster earnings, even though interest rates were higher. And even worse, the Fed might cut 50 or 75 basis points, but you're telling foreign countries also not to trust the United States. Now, here's the biggest worry is rule of law, right? And the solidity in the rule of law in the United States, and why there is this American exceptionalism. Mm-hmm. And what you're saying is you're telling all of those countries and foreign investors, get out of here. We don't want you here.
If you look at the euro, if you look at the USD JPY, yeah, this is a good proxy for the foreign demand for US equities. I'll put this on the screen right here, but you can see that we're plumbing to new 52-week lows. So yeah, foreign investors are saying, gee, I'll invest in our home market. Obviously, European stocks have outperformed. So it's funny because it's make Europe great again,
Yeah.
make China great again, make
Yeah,
Vietnam.
and there's a tug of war there. Like America did very well for the last 3 years, really since 2022, all of 2023, 2024, up through January or so, we did great. And so, yes, we need a pullback. We need that to go back in the other direction. But I would have rather have done that vis-a-vis maybe letting. I would have rather done it another way.
There's a way to do it with a catch up rather than a catch down, right? The reason why the American exceptionalism story has been prevalent for decades is because of greater productivity growth. US, we'll see what happens now, but productivity growth has been stronger, earnings growth, leading American brands, American management, American entrepreneurship. The best tech companies in the world are still found in the United States. Public capital markets, private capital markets, trust and confidence in markets and contracts, in the credit market, in the mortgage market, in that the US will honor its debt, that inflation will be managed, that's a responsible place to custody and invest your wealth, right? Yeah, I spoke to a family office manager in Europe, and they said 70% of the clients' assets invest in the US. That's going the other direction now.
Yeah. No doubt.
So let's shift gears here. Business cycle. So stagflation. Okay. Every element of the GDP equation is going the wrong way.
Yeah.
So consumer pulling back, investment, just also CapEx. CEO confidence is low. They're pulling in. They're not even sure what to do. You have a government spending is pulling back. You're going from
government spending also going down.
And look, I'm all for reining in fraud, waste, and abuse. I'm sure you are, and others are too.
No doubt.
But you've got that element going the wrong direction. And then you're going to, on the trade side, I don't think it's even matter. It's a smaller portion of overall GDP, exports minus imports. So where are you on possible outlook for recession? And can the Fed do anything at this point, given where inflation is? And if they do, is it too little too late?
I have a very small crystal ball. I have a little magic 8 ball here on my desk. But I think where we stand, all I know is what I know right now. And where we stand today, yes, by definition, a recession is in the cards. We're going to have weak. What's a recession? What is it? 2 negative GDP quarters?
That's a technical definition.
Technical, yeah.
Right, but do you have a lowering in final real economic variables like, and employment, of course, is the number one of those.
Yeah.
Retail sales, industrial production.
I think, yes, you're going to see weak to lower spending over today's April 3rd. It's the second day of the second quarter. We're going to see much weaker spending this quarter and next quarter. So by definition, yeah, we're going to see a recession. That will then lead to higher unemployment. It'll lead to lower earnings. If all of the tariffs stick, you're going to see margins and earnings grossly decrease. So you're going to see top line and bottom line revenues for U.S. corporations much lower.
And we're seeing warnings there for Target, Costco, Walmart. Target plumbing 10 to 15-year valuation lows. I still wouldn't buy it. And Costco's got a 50 times PE ratio.
Yeah. Then you add on to that the prospect of actually, you would have expected with a 4 percentage point sell-off in stocks today, you'd have actually expected lower interest rates, like a larger bond rally than what we're seeing today. Bonds are up roughly a 0.5 percentage point. So in the 10 years currently at 406. Okay. So you'd expect the 10-year to be at like 375, like a huge risk off event where bonds are actually up 2.5 points. We're not seeing that. I think at the end of what we're seeing is technical versus cash buyers. I don't think the cash buyers are going to be there on the long end of the curve. Foreign governments are
Where else
pulling
can they
away.
go? Where else can they go? If you want
Corporate bonds.
safety,
So one, they buy
investment grade.
corporate bonds. If you look at the shape of the treasury curve right now, you're still getting 4.3% on cash. Okay. In order to get 4.3%, if you go out to the rest of the curve, you actually have to go out to 15 years. You have to buy 15-year duration, 15-year maturity to get 4.3% yield. Okay. The curve is still grossly inverted, which means it is, if you're going out and you're buying duration, you are speculating.
Right. So
Okay.
short duration, quality credit, is that
Still makes a ton of sense.
makes a ton. Investment grade credit with what kind of maturity you're looking at?
I'm an agency mortgage guy.
Remember,
So,
that was that we talked about that last year.
yeah, and so you're getting paid now. You're getting paid around 5.5% yield to buy Fannie Mae, Freddie Mac, Ginnie Mae debt. Okay, you can buy Fannie 5.5% coupon new issue mortgage bonds at par spot 3. So you're getting like a 5.35 yield on Fannie Mae debt. If you compare that to corporate debt, like a similar duration Merck bond, Merck's A plus rated, for that duration, you're only getting like a 4.3% yield. So you're actually getting 100 extra basis points to own agency government guaranteed paper, which is technically
I think
double
it
A.
makes I think it makes a lot of sense. I agree. And you're benefiting from the fact that mortgage spreads are wider.
Yeah, but it's not just that's fixed rate debt. Floating rate debt still makes a ton of sense. Floating rate high quality debt, okay, which will benefit if there's really a head fake on this rate rally. So if rates retreat back up, and I'm talking about 5 to 10-year treasuries, which are currently at 376 on the 5-year, 405 on the 10-year. If they retreat back to 4.5%, those, if you own floating rate paper, you're going to be sitting pretty. Your yields are actually going to go up and your price is going to stay the same. And you're floating off of 1 month SOFR. So 1 month SOFR is 4.25, 430. You're getting an extra 100 basis points over that. And so you're going to be sitting pretty in a year from now. Hopefully, when the curve normalizes, the curve steepens out.
Floating is a good idea, especially if you have inflation that remains elevated. And if investors demand a risk premium for that,
Yeah.
then you'll be compensated for that risk. The other
It's poor man's inflation hedge.
Right. Now, the flip side of that, though, is that if you have GDP expectations lower, which I expect they will, then you should see the 10-year drop, to your point. I would still expect cash buyers to show up there. I think the market's still coming to a recognition moment. Analysts are walking down earnings estimates week after week. They've done that every single week during this correction.
Yeah.
They'll do it again after
Right.
this week. They thought they were there. Now they're like, no, we're not there.
Yeah.
That might argue for some fixed exposure.
And what's also really, if you look at, so the Fed met 2 weeks ago, and part of their quarterly meetings are they're putting in writing what their expectations are. And they're expecting actually lower unemployment. And 2 weeks ago is 2 years ago now.
That's forever, yeah.
But at the time, they were expecting lower unemployment and slightly higher inflation. So if you were reading those tea leaves, you're like, how is it possible for the Fed to cut? Okay, given what they're saying. And then I was in New York for a week, and I met with a large investor, and what I'm hearing is the Fed's actually going to be politically pressured to cut once, twice, and so most of the reasoning, and this is a high end economist who's pretty entwined with the government, and he's hey, look, I get it, but the Fed is politicized one way or the other. Like
They are. I think they're in a checkmate. Like
and so they're going to be forced to cut. And so what is going on right now is that if in the last 48 hours, oh yeah, I've changed my tune to be like, I was originally thinking, hey, they're actually going to raise rates in this fall. To like, no, they have to cut. They have to get in front of this one way or the other. And it may not help long-term rates if inflation goes back up to 4, 5, 6%. It's not going to. And so when you actually think about what the Fed's main job is. It's a stable economy, right? First and foremost, need stability in the economy. Then it's inflation, or I would say then it's employment, then it's inflation. So it's
Right.
all right. We need a stable economy. A large part of that is full employment. Then we're going to worry about inflation, which brings us back to this is a very regressive tax. It's hurting Main Street the most.
A recession would kill inflation in its tracks. Unfortunately, it would kill inflation at current levels. So there's a comment that came in. Trueflation currently is at 1.34%. Any reactions there?
I look at that website, I don't know, once in a while when people bring it up. And like most statistics, 51% of the time it's wrong. So
Okay.
it's a joke. Like, I'm more concerned about the most recent Michigan inflation expectation numbers,
Mhm.
which are at the 5 to 10 year inflation expectation numbers are at the highest level we've seen since Tiananmen Square. And I would venture to say half the people listening to this weren't alive then. 1989. Okay. Further to that, the market, if you look at break evens today, break evens, 1 year break evens are at almost 4%. So if you don't believe it, if you believe trueflation numbers, guess what? You can go out and you can bet on it. You could go sell tips and buy bonds. Very simple. The 1 year tip is currently trading at 36 basis points a yield. And so you could
Treasury
sell that.
inflation protected bond.
That's the
Right.
yeah. So you could sell that and you could go purchase 1 year bonds at roughly 4%. Okay. That's a 3.5% delta. So the market is saying inflation over the next 1 year is going to be 3.5. You can bet against it if you want.
So
Hey, that 3.5 to 4% kind of makes sense.
part of what's jarring about this is a lot of people listening had double back-to-back 25% year, up 25%
Yeah,
in the equity markets. And there's a buy the dip mentality,
for
which
sure.
people have been entrained upon. I think this time is different because the backdrop conditions are shifting. We talked
Right.
about that. Now, I think having people reorient to a lower return requirement, like you're talking about 3 points,
Yeah.
in an inflation rate, we're talking about 2.5, 2.6, which is set to increase.
Right.
You're talking about a preservation of capital story, really. With
Instead of buy the dip, they should buy the house. They should go buy real. They're talking about financial assets. Go buy real assets. Go buy a house. Go buy some art. Go buy some land. Take the gains.
I like the land idea. I like the land idea a lot. Now, the wealth to GDP ratio has never been this extended,
Yep.
right? It is one of the metrics that Buffett looks at. It also goes by the name Tobin's Q. And as you pointed out, it's a consumer-led economy. Consumer
Yeah.
spending drives 67% of GDP. With the stock market losing $10 trillion of value, is there a reflexive knock-on effect to the business cycle?
No doubt.
No doubt.
Yeah. So what you ideally have, if you really want austerity, what you ideally have is honestly a flat stock market, flat real estate prices for the next 4 years with increasing wages. So wages and purchasing power increases relative to
How do you get
financial assets.
increasing wages if you have challenger layoff announcements and lower turnover in the labor force? So you're laying out
Yeah,
the
basically steady earnings with declining PE. So if businesses are still earning money, but I hate that almost all of the statistics that the market looks at are year over year. Okay. Especially inflation. Because you're talking to people that, oh, inflation's down, but prices are up 25% over the last 4 years. The same thing goes for the stock market. Okay. The stock market cares not only about earnings, but they need earnings growth.
Absolutely.
Okay.
No question.
And so if earnings are flat, okay, you're gonna have businesses. Let's just say you have a business that is kicking off let's say it's a $20 million business that's kicking off $2 million in net income per year. Okay. Not bad. And let's just say you're the sole owner and you get 100% of that. You're earning $2 million a year. But if the top line and bottom line numbers don't grow, okay, the market's going to assign a very low multiple to that, right? Oh, this is a super boring business that only yields 10% a year, right? So the market needs that to grow at crazy levels, crazy unsustainable levels, okay, in order to put a premium on that. So that's all I'm really getting at is let's take a step back, look at, hey, yeah, we've seen a $10 trillion sell off in the stock market, but relative to 2020, we're still up 100%,
Right.
right?
Household balance sheets are still stronger than they've ever
Stronger
been.
than they've ever been. Corporate balance sheets are stronger than they've ever been. We're at the lowest, and this is part of the reason why this, in aggregate, hasn't really affected like corporate spreads and the stability of the US consumer, is because both corporations and consumers have very little debt. We've had this huge delevering, especially since COVID, whereas the government has been relevering, right? So
Right.
consumers and corporate, and so what we need is we need stability so that those consumers and corporations can relever. That will then, and so then we're going to get a sustained for that business I talked about. You just want to sustain 10% a year in income now. You're not that worried about growth. We're worried about sustaining. Okay. So if you're able to do that and bring inflation down, keep unemployment steady, and hopefully balance the budget at some point, but who knows?
There's a couple of threads I'd love to pull there.
Yeah,
One is, first off, you're 100% right. Look, if you have lower earnings growth, that impacts multiples. The
yeah,
vast majority of the present value of a business is based on future growth opportunities.
yeah,
And it's like you learn this in corporate finance
right,
101, but people forget how significant that is. And if you're going from a 10% earnings growth, which is where the 20x PE multiple might be pricing in, to a lower earnings growth, I think the multiples have to walk down. And then you
yeah,
add in inflation to that, and you got
right,
another risk premium from that. And now you've got the White House risk premium, just
yeah,
volatility and uncertainty. It's not a pretty picture for risk assets and just where the multiples in Q4 2018, which was initial trade war,
yeah.
you had trough PE multiple at 14 times.
Wow.
14 times. That's off of a 19% correction from peak to trough. We're down 10% coming from 22 times. So yeah, we're on the 22nd floor of the elevator,
Yeah,
down with a much broader, wider, deeper set of a tariff package, and with lower earnings growth and a weaker consumer than
right.
we had in 2018. That said, we
Yep.
do have stronger household balance sheets. So is there a way that the Trump admin can stick the landing in 9 months? You mentioned that right now it's not on them. They'll message to the globalists, right?
Yep.
And they'll blame the Biden. And look, by the way, there are legitimate issues there. We
Yeah.
shouldn't have
No
had
doubt.
7% wartime deficits.
Yeah.
Yes, Europe should be paying more for defense. Yes, Canada should be writing. Like the pharma, they're legitimate issues. Of course, I think it's just around approach. But how do you stick the landing here? Because economies have their own natural momentum.
Yep.
If you have to do a fiscal pump, then you're going to increase deficit spending, which is what you're trying not to do that. So
Yeah.
how do you manage that?
I think what they did with Ukraine in a microcosm had exactly the results that were desired, right? Let's get Europe more involved in defense of
Mhm.
Ukraine. Let's Germany all of a sudden says they're going to issue a ton of debt. They're going to get much more involved. The United States gains mineral rights. They actually gain something for spending money. So you have this great result. And you're bringing Putin to the table. And nothing's really happened yet, but you're talking about a ceasefire. You're talking about, hey, this Ukraine thing might be done in 18 months. And now Europe is actually coming to the table. So what do you do at this point? You let this tariff thing simmer. He's not going to walk this back in a day, but he could walk it back by the end of the month and say, hey, wait, all right, we're just going to do 10%.
I don't see
Um,
that.
the, what,
What at the
what,
end of the month?
what Ukraine was bilateral, which is country by country. What the administration did was unilateral, right? And so that's not the way really to go about things. But I think we only have 45 to 60 days.
There's an intervention window, I think is what,
Right.
right? I agree. There's a time to intervene because when an economy slows down and the business cycle goes in reverse and you get delinquencies and defaults and risk aversion goes up, then people pull back in,
Yep.
entrepreneurs don't create jobs, and then layoffs start to happen.
Right.
So intervening is important because the cost of intervening 9 months later, when
Yeah.
it's a recognized recession, is substantially higher.
Yeah.
The Great Recovery up to 750 billion, 770 billion. The Bush tax cuts package was 350 billion or so.
Yeah.
We left stimmy world. We don't want to go back to that. A couple trillion there.
Yeah.
And that would wipe out the revenue from the corporate sales taxes, aka tariff. So I don't think they will. I don't think they will in 30 days. I do believe that in the bones of Trump and Howard Lutnick that they view this as a transformation. I'm not even speculating. Lutnick was on CNBC
Yeah.
and Bloomberg this morning. I listened to what he had to say. Let me share with you the verbatim quotes. I took down his notes. He said, quote, "It's not about tariffs. It's about non-tariff trade barriers." Okay. And there's some merit to that. Sure. He says, this is about a reordering of global trade. This is about a reordering of global trade. That's a multi-year effort. It's not an April Fool's joke. It's not going to be a month. Hey guys, we're kidding.
Yeah.
Go back to what you were doing again. And Vietnam, thumbs up. Trump has been channeling William McKinley. He's been talking about how the American Republic was financed with tariffs. He links that to the growth of the American economy when, of course, that was industrialization, innovation, cotton gin, use of the steam engine, massive immigration. So I just don't think I just don't see that. And Trump trade war 1.0, Q4 2018, it was a 3-month process.
Yeah.
And that was focused just on China.
Yeah.
The news flow that we're going to see, you're going to wake up with a Wall Street Journal, like just the markets are going to get whacked on the head every other day. Good and bad. You'll get a win probably in India. Mexico and Canada were carved out, which is positive news, by the way. Yeah, that is positive news. Those are our most significant trading partners. But I just don't see that they're going to say, hey, just kidding, get back to business. And if that's the case, how do you avoid a downturn?
Yeah, if you think back to COVID, remember like all the ships ported in Long Beach for how long was that thing going on? Like months.
Yeah.
It was on the news cycle every day. And so I think what they're really going for is a 18 to 24 month reordering, not only of global trade, but of the US supply chain. And that, if you just think about that and you're like, okay, if I'm buying this pair of Lululemon pants from a US manufacturer where employees are getting paid $20 an hour versus a Vietnam manufacturer, and I think a lot of Lululemon's made in Vietnam. So, like, you just think, okay, not only is it going to take 12 to 18 months to actually do that, and those are already like $100 pairs of pants, and so you're looking at a really regressive tax that is going to cause a tremendous amount of. Can it happen? Yes. Is it going to take 12 to 24 months? Yep. Is it going to cost a lot of money? Yep. So if that's what you're planning on doing, some real
CapEx
pain
goes
coming
up,
down the
margins
road.
goes down. One of the things that's kept the multiple higher is that corporate profit margins haven't mean reverted. Up until the last 15 years, corporate profit margins exhibited mean reversion.
Yeah.
And they maintained a high level because of the current trade ordering that we have in the world. That's going in reverse, which adds more pressure. As we talked about earlier, either the consumer pays the bill or the company pays the bill. So it's either inflation or lower earnings, none of which helps markets. So I don't know that they can pivot in time to to have a timely intervention. They might be forced to have an intervention later in the year. And I'm not sure they've connected all the dots around this.
Yeah.
Really, they wanted to win the midterms. Besson, excuse me, he was asked this question, why was Canada and Mexico excluded from this? And he responded, I don't know. Okay. And Felix from Forward Guidance, he says, quote, so Besson is totally in the dark on all of this, it seems. I was speaking with a friend in Puerto Rico, and he's like, look, Besson's the adult in the room. We're good. I have a lot of friends that I think myself included, I think, I'm sure that, yeah, Besson's the guy, right?
Yeah,
Besson's
yeah.
there, and he truly does understand markets at a very deep level. He also said he's not, excuse me, he's not negotiating these deals. He's sidelined.
Wow.
That's not going to expire market confidence.
Yeah, no doubt.
I don't think they're connecting the dots on how these things unfold. And they're just a lot of contradictory policy objectives. Let's talk about advanced robotics, for example.
Yeah.
Your friend, the entrepreneur making the hockey sticks, he can't use advanced robotics to make hockey sticks. The labor, the
Right.
cost of them. If you have a business generate 250,000 net income, you can't invest in advanced robotics. I'm going to give you the phone call.
Yeah.
Okay. So now I had a conversation with a Chinese entrepreneur who sells plastic moldings to HVAC suppliers across the United States. By the way, most small businesses are like this, very, very niche.
Yeah.
They do it
Yeah.
really well and they make good money. Okay. So he was sourcing overseas. And I said, how are you responding to tariffs? Now he lives in the US. He's a permanent resident of the United States.
Yep.
Living the American dream, pays a lot in taxes. He's proud to do that. And he's glad to have escaped the China regime. Okay. He says, oh, I'm going to invest in advanced robotics, which is what Lutnick wants actually.
Yeah.
So I say, this is actually their point. This is Lutnick's point. But he said, I'm not going to hire any workers because what I am spending in OpEx overseas, I'm going to replace with one-off CapEx here.
Yeah.
And hire one person to run the
Right.
advanced robotics. So it's not going to create employment on the advanced robotics side. If
Right.
you can't have advanced robotics, your margins go up and you're put out of business
Yep.
if you can't compete. So what are we really doing then? You're bringing manufacturing locally, but you're not creating jobs and you're creating higher costs for end consumers and lower margins. It just doesn't seem rational. It doesn't seem to fit well together.
Yeah, it is really a forest for the trees. Going back to the Long Beach example, wasn't it the Long Beach longshoremen?
Longshoremen, yes.
Yeah, that went on strike against robotics. They're like, hey, our jobs are being roboticized. And so they negotiate, and the main sticking point in what they were arguing for was, hey, we don't want robots. We'll accept slightly higher compensation, vacation, whatever, but you can't employ robots here. So you're sticking a knife or a fork in progress in the name of, hey, we want to continue to employ longshoremen in manufacturing jobs, etc. But it is really forest for the trees in terms of, okay, if you're doing all of that, let's just say the stock market's currently at 55 trillion. Let's just say you cut $20 trillion off of the stock market. Is that worth it? Wouldn't it be better to print $20 million or $20 trillion and cut stimulus checks or whatever, put it in CapEx, put it in FDR, Eisenhower, let's build more railroads and let's build more highways. So we're in the kind of find out phase of FAFO.
It's FAFO. Now we're in the find out phase.
Yeah. So
we'll see. Let's focus now on the housing and the mortgage market.
Sure.
Bill Ackman has desperately wanting the privatization of Fannie and Freddie for a long time. They've been sitting on these preferred shares for a long time.
Yep.
Look, I'm all for privatizing Fannie and Freddie. It would create hundreds of billions of dollars to the U.S. Treasury, can pay off the debt. However, we also need mortgage rates to come down to create affordable housing.
Yep.
And when you are backed by the full faith of credit in the United States government, you're going to have a cheaper borrowing cost than if you're a private entity.
Yep.
Because a private entity is going to focus on profitability. I'm all for capitals and profitability, sure.
Right.
Merely pointing out an inconsistency, yet another inconsistency in the stated policy objective. So question is, will that even happen? Is that even in the cards given this backdrop? Can they actually privatize Fannie and Freddie? They have to wait for a better time.
From the analysis I've done, they need to actually have a much larger capital buffer. Okay. We're talking about another hundreds of billions of dollars of capital just to get back to where they were pre GFC. Okay. And the agencies, the GSEs, Fannie and Freddie here, there's a really good book out there called Mortgage Wars, which was written by the CFO of Fannie Mae or Freddie Mac. And these GSEs, they only run capital of about 2.5%. Okay. Bank capital requirements are 10%. Okay. So the GSEs are running a very thin slice of capital just to get back to there, and they make about $25 billion a year combined earnings. Okay. So we're talking about 6 to 7 years just to get back to that level where they would be capitalized sufficiently. Okay. Further to that, the Treasury would have to basically write off a large portion of their preferred shares. Okay. They're not going to do that. And the last stick
Why would they have to write
road,
off preferred shares? Because it has an ownership claim.
to basically, it's part of the equation. If Bill Ackman and these guys are arguing for, hey, they should privatize this in 12 months from now. Okay. The only way they're going to be able to do that is and have sufficient capital is if the Treasury said, hey, we're not going to get paid anything. We're gonna take a warrant or something like
Well,
that.
the Treasury would give up the annuity stream that they earn from the GSEs for a large one-time gain from the sale through the public offering of Fannie and Freddie. And couldn't that public sale attract the capital required to meet,
Potentially, yeah. So but my argument is, hey, look, they need a lot more capital than 2 or 3 or 400 billion. They need $1.5 trillion.
There's no way the market can absorb that kind of. That's bigger than Aramco.
And I'm not talking about, we're going to sell 10% of our shares. I'm talking about, no, we actually need to raise like $1 trillion in capital, right, in order to be sufficient enough. So then the third leg of the stool is if they don't do all of that, if they go with hey, we're going to raise $300 billion. And again, the stock market just lost $1.5 trillion in the last 24 hours. The government's hoping to raise $700 billion with these tariffs. Right. We're talking about $200 or $300 billion. This is nothing. This is nothing. Okay. It's a very small piece of the federal government's budget at this point in time. Okay. So the third leg of the stool is what happens if all of this, the agencies are going to have to start rating Fannie and Freddie as non-government entities potentially. Okay. Their ratings maybe drop from AA to BB or BBB or something like that. And mortgages become much more expensive. Okay. I'm talking somewhere between an extra 20 to 60 basis points of spread required to buy these mortgage bonds.
That's too high. We're at 6.6 all in now. That'll push.
That's going to increase mortgage rates to 7.25. Okay. Do the math. The U.S. mortgage market's about $14 trillion. Okay. In a good year, there's $1 trillion in issuance, maybe $2 trillion in issuance. What's that times 50 basis points? It's not small. So if you really want to raise prices for consumers, that's a great way to do it.
It would hurt affordability. It would slow down the.
So could it happen? Sure. Would it be very ill-advised? Yes. And there's talk of, we're going to put this, we're going to do the IPO, or we're just going to shuffle this over to the new sovereign wealth fund. Okay.
Is there any reinsurance model that could work? The Fannie and Freddie was the reinsurance. They are the buyer of last resort. For example,
there's already a model set up, which is Ginnie Mae. And Ginnie Mae is a government-owned entity. Okay. Banks get zero risk weighting to own Ginnie Mae bonds. That's a 25 to 50 basis point insurance. And then there's a question of, okay, you still have this implicit guarantee here or explicit guarantee. It's government owned now. Question being like, okay, how much is that? What is that? Where does the money go then?
Why not put it in the sovereign wealth fund? The U.S. retains preferred share interest.
Yep.
They IPO the business, and the U.S. gradually sells down their equity position. The U.S. maintains their backing so that the GSEs have a AAA rating, which keeps the cost of financing low. Yep. Is that a plausible path?
Yeah, for sure. Like all of this could happen. They can move it to the sovereign wealth fund. There's an explicit guarantee or there's an insurance model. But then it's okay, what's the point relative to today? Okay, somehow, some way we're going to extract $250 billion.
That would be the objective, yes.
That would be the objective.
And Bill
The
Ackman would
Senate,
be
the
happy.
Senate right now is passing a $5 trillion tax cut. Like, this is
What
a
are we?
flash in the pan.
The wrong focus.
Yeah, it's like, why are, like, I think if you read what Pulte's doing right now, the head of the FHA, I read his entire Twitter feed yesterday, okay, since he started. And it's all about shedding a lot of extraneous programs, making homes affordable, actually bringing mortgage rates down relative to, oh, let's find a way to cash out and increase mortgage rates. So I think we're still talking about hopefully something could get done by the end of this administration.
Got it. So plausible, but maybe near the end of the administration, it's likely going to be distraction now. They can't afford to raise mortgage rates.
I think so.
Yeah, no, I'm landing on that too. I find it surprising that the Fannie Mae preferreds are trading where they are, given all of that. I haven't researched it carefully, but
I won't post it here, but I'll send you this
yeah.
JP Morgan write up, which basically says, hey, this is a 5 to 7 year type of plan. And it lists out what I was talking about, which is treasury preference, they're undercapitalized, and how is this going to affect mortgage rates? How are you going to create something that doesn't affect the end user?
They would need Saudi Arabia to back the GSEs, which is I can't imagine that either. But
Sure.
so let's shift over to corporate credit. So
Whenever the PGA and Live come back together, that's the timeline we're looking at.
yeah, I agree. The funny thing about the PGA Live, that's foreign ownership of American assets,
Right.
which is what you get with SoftBank investing in the United States, which is what you get when Taiwan Semiconductor invests in the United States.
Yeah.
Which Trump is taking victory laps on.
Yeah.
But that's financed by the trade deficit also.
Yeah.
So you can't have them both at the same time.
Exactly.
Let's see. So corporate credit, let's talk about the CLO market.
Sure.
First off, maybe introduce CLO market for the audience, and we'll talk about the current state of the CLO market. And I'd love to get your perspective on the dislocation there.
Yeah, not too long ago, the only way for high yield borrowers to get financing was either A, getting a loan from a bank at 5 points above where the bank is getting money from the government, or going into the high yield debt market, which is fixed rate. Okay. So the underlying loans, called bank loans, these are bank sponsored loans to Caesar's Palace, for example. Double B rated credits priced at 5, 6, 7 points over SOFR, i.e., fairly risky. These are B and double B rated credits. And only in the last, I would say, 5 years has it become much more expedient and actually cheaper to borrow in what's called the leveraged loan market versus the high yield debt market. Okay. So now, much of the structured products market is based around ratings, okay, and really arbitraging whether it's insurance company requirements or bank requirements or US government requirements or foreign government requirements with what banks and insurance companies can own.
They're
Okay.
eligible investment requirements.
Yes.
Yeah.
So if that bank owns that B rated credit, they have to post 100, if not higher, percentage of equity capital versus that credit. So if it's $100 million loan and the bank has to post 100 or $200 million worth of equity against that loan, it makes no sense. So what does the bank do? Is they sell that loan off into the market. Let's say it's a $300 million loan, and you find 100 $3 million buyers. Okay, great. You sold the risk, you actually made a point or two on the transaction. But what CLOs have been able to do is they take those $103 million loans, and now it's diversified. It's 100 different companies that you have exposure to, and you tranche it out. You have a AAA tranche, which is the top 40% of that structure. So you have 60%, or I'm sorry, 60% top. Let's say you have 40% subordination here. You can survive up to 40% in underlying losses before the AAA gets hit. Okay. That AAA CLO tranche right now trades at about 140 spread, 130, 140 spread over US Treasuries. And it's floating rate. All of the underlying loans are floating rate loans. That's cheap. Okay. I mentioned Merck earlier. Merck's an A plus rated company that's trading at 40 over. You could buy a AAA CLO at 140 over. Okay. So the big buyers out there have been like US banks. One of the biggest buyers is Norinchukin Bank, okay, in Tokyo. It's a big agricultural bank, and Japan loves these. But it is just an arbitrage, okay? Because when you actually do them in triple Bs, for example, are also purchased by insurance companies love triple Bs because they still get fairly good regulatory treatment. And instead of buying it at 140 over, they're buying it at 250 over, which is like right now almost a 7% type of a yield for a very low duration. It floats monthly. It's still triple B rated, still has 15% subordination. So you can take 15% of losses, maybe 20% subordination. So you tranche it out. But when you actually do the math on how much it costs to do that securitization and who's paying those costs, you can understand why banks love this product. The originators love the product because they're making investment bankers as well as the managers, the big managers out there being like a Magnetar or an Ares or a Black CLO managers. Okay. So you add up all the fees that are getting siphoned out of this deal, and it's 3 to 5 points up front plus points running. Okay. Where's the money, Lebowski? Where's it? What I tell folks is, why don't you just go do it yourself? Why don't you go own the underlying loans and finance them? Then
That's hard to do.
Yeah, we don't get our AAA rating. We don't get our triple B rating. So fast forward to where we are today. So these have been great assets for the last 3 to 4 years because rates have been rising. These bonds generally have zero duration because they're all floating rate. The underlying loans are all floating rate. But now we're hitting this point where, again, there's credit risk. Okay. And can these companies that were paying SOFR plus 5 when SOFR was at 0 or 1, now they're paying SOFR plus 5 or 6 or 7. How many companies are set up to legitimately make 9 to 11% coupon payments? Okay. That wasn't in the cards. So the actual debts in CLO guys, bank loan guys will say these leverage loans, they go by a couple of different names. Leverage loans or bank loans are safer because they're senior in the capital structure. Like it is the senior most debt.
The first to get paid.
The first lien. But what they won't tell you is the underlying companies, there's only about 15% of equity. Okay. So there's 85% of debt, 15% of equity. You divide 50, and here's how you figure out how levered they are. You divide 15 into 100, it's 6.5x. So you're 6.5x levered. Okay. And let's look at Florida housing right now. So meaning if the value of the company goes down by 15%, the equity's gone.
Which could happen through tariffs or higher prices,
very easily.
Weaker consumer.
Restoration Hardware is down 40% today. Okay. Contrast that with high yield fixed rate debt. U.S. corporations have the least amount of leverage today ever. So high yield companies are only 1 to 1.5 times levered. So whereas that high yield debt is what's called a general obligation debt, okay, you actually don't generally have, you're not the last man standing, but long story short, those corporations are in a much better spot from a leverage perspective than the high yield or the levered loan companies are. Okay. So they're very levered. And then you take that triple B, for example, that triple B in and of itself is 6 to 7 times levered. So because it's way down there in the capital stack. So multiply 6 times leverage times 6 times leverage. You now own this triple B. You own a 36 times levered instrument to make an extra 250 basis points.
Well, no, the yields now are 18 to 22%. for CLO equity right now. So
Equity,
that
right?
market
So that
has
equity is 12x levered. That's the 0 to 8, maybe 0 to 12 times slice, the first loss piece. You
right.
have no protection. So you were at 10 or 11% yield. Now you're at 18 to 20%
Right, by
yield.
0 to 8% slice, I mean, of the collateral pool.
Exactly. So the yields
The
have
most
gone up.
levered piece of the collateral pool, the first loss piece that
Yeah.
enjoys the financing from the senior tranches.
Yields have gone up. Just like you said, yields are up 8 to 10% like that. Okay. Because there actually is a worry that these companies may not be able to actually continue to pay their
Right.
debt.
So what's happened now? So I'll share this post with you. I shared
Yeah.
yesterday. I had a friend, sharp guy, KKR, Canadian Pension Plan. I'll leave him nameless for now. You probably know each other, but
Yeah.
he said, yeah, credit is selling off in high yield and leverage loans. Of course, we've seen the widening in HYG, for example. He said anything with medium term maturity, 48, 72 months is getting hammered. Talks about new deals are pricing wider. And he said, payment in kind bucket keeps increasing. That's a
Yeah.
warning flag, of course, when people
Yeah.
say, hey, I won't give you cash, but how about I owe you more? And then he says on public CLO
I'll
equity,
gladly pay you tomorrow for a hamburger today.
yeah, exactly. Checks in the mail next year. So,
Beer's free tomorrow.
exactly. So he says on public CLO equity, not seeing pickup in defaults. It's mark to market pain.
Yeah.
No concern about credit quality. Currently, now this is before the tariffs.
Yeah.
And that changes a lot.
Yeah, no doubt.
A lot. Obviously, this conversation goes in a different direction.
Yeah.
So he's making the bull case here. He says, look, it's a question of how much tariffs will hurt. The bigger the negative impact to your earnings, more likely you will have cross-border exposure. No, the bigger your EBIT, the bigger
Right.
your earnings, the more likely you have cross-border exposure, and the more likely you get hurt from tariffs. He said the tariff risk factor currently is unknowable until we know Trump's tariffs policy. Obviously, saw Salvo 1 yesterday.
Yeah.
The CLO equity is much wider than BDC yields, and BDC yields can get much more NAV impairment. CLO equity is much more diversified. Single position risk is much smaller. And yeah, so the yields are like 20% now. We also saw a technical dislocation, although marks were coming in and
Yeah.
sold off. We picked some up there. We're up from that, but we're re-underwriting that, just given all this now too. So what are the points that he's missing in that argument?
The argument for the CLO structure and CLO equity even is that into lower interest rates, which could happen, borrowers are paying less. They're actually in a better position to continue to borrow. And potentially you can reset these underlying deals so that and re-arb them, so to speak. And generally speaking, once that deal is struck, once the CLO is struck, there isn't any additional leverage that's put onto that.
The CLO manager can kick out credits, but the market knows who the bad credits are. And it's a question of hot potato and pricing risk appropriately.
Exactly. But when you're talking about BDCs and or closed-end funds, okay, and there's a couple of closed-end funds out there that own this stuff, and they got destroyed in the last 2 weeks, okay, because they're also using leverage.
Is there a ticker I can look at that represents maybe like
EARN.
Golub Aries?
EARN. EARN.
EARN. Ellington.
Yeah.
Okay. I'm going to pull up on the screen here. Ellington Credit Company.
They're down a point. Let me do total return here since the beginning of the month. Since the beginning of March. 03, 01 to 25 to today. They're down 19% in the last 35 days. So this ticker recently converted from a mortgage REIT to a CLO closed-end fund. That if you read their description, they are primarily owning CLO equity and mezz. Okay, but because it's a closed-end fund, a lot of closed-end funds and BDCs can use anywhere between up to a third and a half eternal leverage. So you're also levering that up. So you got leverage upon leverage, and so it's just kind of. I want to caution folks on like when you own corporate credit, and this is CLO equity is part of that. You're gonna have some beta to the stock market. These are companies, these are corporations that are borrowing. And if stocks are down 5%, you should also expect
how about
leveraged loans to be down.
So I think right on the mark. This is showing business cycle credit risk.
Right.
So this is down 1.6%. I don't know this name from a hole in the wall, just to be clear.
Yeah.
But it's priced in a lot of damage now. The market's
Yeah.
down 4 points. This is down 1.6%. It's got some relative outperformance. And if you believe there's business cycle risk, you would want to be more senior in the capital structure. And this gives me that exposure.
Yeah.
Said differently, aren't those risks priced in, and aren't I compensated for that risk, especially if you believe that the White House pivots and focus on more growth, pro-growth, tax cuts, etc.
I think if corporations are in a great spot, okay, but you have this huge unknown, which is how are tariffs actually going to affect these underlying companies? Nobody has any idea. It's actually going to take 4, 5, 6 months for that to actually flow through to whether or not these companies are, how reliant they are on international trade. So who knows? Would I be saying buy the dip right now, generally speaking? If you know what you're doing, yeah. And if it's just a technical, sure. But I think one thing to point out on that previous chart is the volume chart. The volume chart was down on the bottom, the bottom
Yeah,
part of that
I saw
screen.
that.
So that's really what freaked me out on a couple of these names. Was I was like, holy crap, there's some huge sellers coming in. And if you're in a BDC, and this was my point, was not about CLOs or leverage loans. It was really about the structure of a BDC or a closed end fund. Okay. In order to sell your shares, you're not selling it back to the company, you're selling it to another buyer. And this movement is much more indicative that there's a lack of buyers than that there's problems here. Does that make sense?
Yeah, it does. It's a market liquidity issue.
Yes. So there's been this huge amount of flows into CLO vehicles, CLO ETFs in the past 2 years. We're talking in the Wall Street's basically saying, oh, CLOs or ETFs are actually going to take over as the largest buyer for the next 3 to 4 years. Okay. We're going to go from 22, 23 trillion dollars in CLO ETFs to 50 to 60 trillion dollars like in the next 3 years. And so this is a retail product. Folks are looking at these entities and saying, especially the AAA CLOs, and saying, this is the same thing as cash. Okay. Instead of putting my money in a money market fund, I'm going to put it in it, and I'm not going to name any tickers, but they're going to put it in a AAA CLO fund. But if you look back to COVID and what happened, there was a 2-week time frame where CLO AAA spreads went from like 150 to 550. They snap back real quick, but that's the equivalent of a 10 to 12 point loss if you hit the panic button. So be very mindful of the way in which you're investing in these, because I think long term, you're fine. But if you're accessing, let's say, an equity CLO fund via an ETF, you're competing to get out the door with a lot of other guys who you may not panic, but they may. That's the problem.
You can get mark-to-market issues,
Yes.
even if the underlying NAV is fine. So
Yep.
if you get involved there and you do your underwriting, make sure you can hold to maturity. There's no maturity
Yeah.
concept here, but the concept of the weather through the trough.
Yeah. But I have investors, for example, that are actually margining these, levering up. So if something drops by 10 points and you get a margin call, you also better have the money to pay it.
You want to match fund your borrowing with the
Exactly.
duration of the asset, and you want non-callable debt. That's obviously what Warren Buffett does.
Yeah.
When he borrows from Japanese banks, he can't get a margin call, and that's the mistake that people make. This last question, really last topic here, around the banks. How do you see the banks playing out, particularly the smaller banks? We know the large banks have loads of capital. They'll do fine.
Large banks are doing great.
Yeah.
Any bank, I would say under 5 billion, they're still licking wounds from 2022 from massive bond write downs. Okay. And this actions actually helped them out a decent amount. But I don't think that story is going away. I don't think interest rates are going back to 2, and I don't think deposit rates. You're seeing deposit rates slowly go higher, and bond yields effectively stay the same. And so banks are still, now it really comes down to their folks haven't had to worry about their loan book for years now. Okay. Now, guess what's happening this year?
Pretend and
A-
extend. Right.
All of the 5-year balloons that were underwritten starting. And so a lot of commercial debt out there are 5-year balloons, 25-year AM, 5-year balloon. What does that mean? It means you may be able to refinance after your balloon, that you don't have to pay that balloon. You might have to refinance it. But okay, you borrowed money at 4 in 2020. Now you got to reset it and borrow at 6 3/4. Okay. So you can extend that, but the bank's not going to accept 4% coupon anymore. Interest rate. The bank's going to say, no, we will waive all these covenants, but you got to pay us 6 3/4. The 5-year right now is at
Are
three
you
and three
seeing
quarters.
that, or do you expect
Oh
that?
yeah, I see it.
Okay.
I'm rolling debt 3 points higher than where I underwrote it 5 years ago. I'm getting quoted on mostly multifamily debt at
Right.
3.
But
Here's the back of the envelope. Add 3 points to the 5-year. So that's 6 3/4 right now. So do the math on, yeah, you might have a low LTV as it stands. Okay. But most of these banks, they are DSCR underwriters, debt service coverage. Okay. Are you going to be able to meet 1 or 1.1x debt service coverage when your debt goes from 3 3/4 to 6 3/4?
how do you explain Ozark Bank and East West Bank and Western Eye? These Western Eye is probably healthy now, maybe.
Yeah.
Ozark Bank, loads of CRE issuance.
Yeah.
And I'll tell you the story. I had with a friend also in the CRE market, which surprised me. He said that the bank he's talking to is enabling new capital to enter, assume the asset, and enjoy the same terms as a 2020 borrower under pretend and extend, so that the bank can avoid taking an impairment to their equity.
Yep.
First time I heard that, it's one anecdote, but a serious guy, and I thought that's a very interesting. Now then I look at Bank of Ozarks. A lot of banks, like Bank of Ozarks, I call them out only because they were one of the most aggressive lenders of commercial real estate. And if you look at other CRE exposed firms in the public markets, notwithstanding the recent correction on the East Coast, they've recovered sometimes to all-time highs, right?
Yep.
Now, how do you square that away with what your observation is? Are the banks being selective, or the banks saying, hey, you have equity in this asset, we did a valuation, we're gonna charge you market terms, and then maybe for at-risk assets, they say, hey, we'll take a pretend and extend approach? Is that maybe they're bifurcating? Is that possible?
I think a large part of it has to do, and I'm looking at Ozark NIM, net interest margin. It's declining, which means their yields might be the same, if not going up, but their cost of funds is rising, right? So that said, you're looking at a lot of banks out there that have really low cost of funds still. Okay. So if you only have a cost of funds of, let's say, 1 to 1.25, which is standard for community banks, then there's going to be a huge multiple paid for your equity. Okay. Because you're almost like a takeover target of, let's say you got $50 million in equity and $500 million in deposits. And those deposits you're only paying 1% on. Your equity value, you might be trading at 2x book value. Like your equity might be worth. And so people are willing to like really close. Same thing with tariffs. No one batted an eyelash until last night at 4 p.m. And futures going into 4 p.m., going to the close, the stock market was actually up yesterday.
50 bips right after the close.
And so then it was down 4%. The futures were down. So it's not even a kick the can. It's a let's close our eyes and for the news in order to sell, and just hope that there's adults in the room that are managing these loans properly. But it's not hard to figure out the underlying factors that are affecting especially all real estate, which is rents, insurance, taxes, and cost of funds. Insurance is going up, taxes are going up, rents are flat, and cost of funds are going to be going up dramatically. Interest rates are going to be going up dramatically. So, is there going to be a buying opportunity? Yes. When is that? I'd say it's 6 to 12 months after there's this shock of, oh crap. And banks don't really have to report necessarily. They have to report it to the regulators, but I don't think they have to report it publicly. All other like covenants.
And they're not. I've looked at some
they
of these banks, and they're
look
not.
past.
The quality of the reporting. I've talked to construction managers and CRE developers, and I asked them about what banks are using and what terms they have. And they're in the thick of it.
Yeah.
And so they know which banks have issues because they know which
Yeah.
properties they have with non-recourse debt. So, and they're like, yeah, that bank hasn't disclosed this, that, and the other thing.
Yeah.
Yeah, I agree. There's some shenanigans out there.
So and you got to think about the people that are sitting in the seats that are doing this reporting, et cetera. Like they're trying to keep their jobs. And it's do private equity companies, do investors in private equity and VC value their holdings based on secondary market transactions? No. That's somebody else's problem.
Private credit has no mark-to-market impact today. That's
Until it does.
Until it does. Until the cash flow doesn't show up. That's what that really means.
And so it's the same thing. You aren't actually going to write off that loan or start impairing that loan until you come to head with the borrower and the borrower says, hey, look, I'm not paying you. And it might even be 60 or 90 days past that to where you're like, oh, we got to impair that loan. But if the borrower is sending you their regularly scheduled payments, you're good. Right. Even though they may be only interest only still. You're in a good spot until that point. So watch cost of funds. Watch like NIM. Bad debt is really hard to watch because there is a lot of sleight of hand that banks can do. And look at tangible equity value.
Right.
Yeah, and so you're looking at banks that are supposed to be holding 10 to 12% equity cushions. And in reality, they're only holding 5% equity cushions.
Because of the debt that's not recognized.
Because the debt's been written down and it doesn't have to be realized until it's realized. So banks are still very levered. And the next pin to fall or the next, what could break the camel's back here is a downturn in real estate. That has really been the can has been kicked down the road outside of those borrowers that are paying floating rate debt. Most borrowers have fixed rate debt, but most of that debt's going to start rolling this year.
Got it. How do you feel about the regionals, like the Truist, the M&T banks of the world, Citizens of the world?
I think they have a big enough franchise and low enough cost of deposits and enough business banking i.e. their cost of deposits are lower. They weren't doing a tremendous amount of risky lending. And they were much more fee-based / hey, we're going to rely on paying people 0.01% and we're going to invest it in T-bills. And that's what how JP Morgan's done great. And B of A has a tremendous amount of unrealized losses, but it's so large that the number's high, but the percentage isn't that bad. In aggregate, there's a lot of bad debt out there. There will be, but it's going to be swept under the carpet because of existing net interest margin from low cost deposits.
It goes back to what we talked about earlier about just the kind of conflicting objectives from the kind of the policy. I like the idea of letting banks getting back to lending, then encourage small business growth. But if you're stressing borrowers and their margins and earnings, banks are going to go into a crouch position. They're watching their stock equity value drop right now.
Yeah.
That loan officer survey from the Fed is going to come out and say they're going to pull back. And this is called reflexivity, right? It's like you have a market impact. Soros, exactly. Yeah. I think the main takeaway is they need to recalibrate quickly.
No doubt.
Because the cost of intervention 9 months from now is going to be too little, too late. And the Fed cutting, you see, if the Fed's cutting in front of a recession, you might get a temporary goose to asset prices, but it doesn't really matter.
Talk about reflexivity. Has higher rates hurt the market? Not really. So
Correct.
how are lower rates going to help the market?
Yeah. And look, higher rates reflected higher nominal growth expectations.
Yeah.
In the same way we had that in the late 90s or in the 2004 to 2006 era. Lower rates reflect lower earnings growth. And so, yeah, it's good.
You need to bring back confidence on a consumer front and a corporate front to
Psychology.
spend. We are everything we measure is based on consumption. So how do you get people to spend?
100%. That's where we
That's all it's
started.
about.
Right? We had the soft economic data and the surveys, and that's translating to the weak, hard economic data, which is starting to happen now. Terrific, Skyler. Thank you so much for the time. Always a real pleasure. We'll have to do it again.
Yeah.
How can folks follow you or learn more? I think we've got your link to your Twitter handle is here. That's
Yeah, Regan Capital. Look me post almost daily on LinkedIn and Twitter, if not sometimes 4 times a day.
I really enjoyed the post. You're one of the few people
I'm
covering.
not trying to pat people on the butt. I'm trying to actually educate and add some value.
Exactly. Thank you, Skyler. Until next time.
Cool. Thanks, Ram.
Thank you for listening in on the episode. Remember, in the world of investing, the road less traveled often leads to the greatest rewards. I'm Ram Ahluwalia, your host and Chief Investment Officer at Lumida Wealth, where we specialize in the craft of alternative investments. Invest wisely, stay ahead of the curve, and stay non-consensus.